On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Let's run through last week's key developments, then let's turn our attention to what's coming up in the days ahead. Global share markets had another good week last week. The S&P 500 in the US rose 0.9%. We did see some mixed inflation indicators. The CPI was a little bit softer than expected. The PPI was stronger. And we did see a higher than hoped inflation expectations measure in the University of Michigan survey, but still the market was up. We also saw some solid retail sales, but some softer consumer sentiment figures in that same U of M survey. UK shares were 0.5% higher, Europe was 1.4% higher, and emerging market equities gained 1.5%. The Japanese market continued its strong run with the Topix index in Japan adding another 2.8%, so it's been very strong lately. Closer to home, the Australian ASX 200 was up 1.5% and the local NZX 50 rose 0.3%. Looking at where all of those markets are at year to date, and it's pretty good across the board, apart from here in New Zealand, we continue to lag. The Aussie market is up 9.5%, the US market up about the same. UK shares, the FTSE 100, up almost 12%. European shares up a little more than 9%. Japan up 11.5%. And emerging market shares are the star so far this year. They are up 18.3% year to date. The local market down 1.7%, so we're very much lagging. Let's hope that a reporting season next week gives us some good results and sees our market catch up a little bit. Interest rates were little changed last week. We saw the US 10-year Treasury yield finish the week marginally higher at 4.3% and the local 5-year swap rate ended the week at 3.4%. Not a lot of change there. Looking back through some of the key releases and events, and US inflation was in the spotlight. It was weaker at the headline level, but a little higher at the core level. So you can kind of pick and choose which story you want to focus on and whether you want to view it with a glass half full perspective or a glass half empty perspective. These figures were for July, and at the headline level, we saw the inflation rate steady at 2.7% annually. That's compared to forecast for 2.8%, so it came in at 2.7, a little bit softer. The core inflation rate actually did accelerate to 3.1%. Now, that was above forecasts for 3.0, and it was the highest since February. There was some evidence of tariff-induced price rises in some categories, things like household furnishing, things like apparel, not to a significant degree, but it is there. We saw the PPI, the Producer Price Index, later in the week, and it was a lot stronger. So again, good news and bad news there. However, markets did choose to respond positively to that, and they did seem to focus on that lower headline CPI print, and they see a Federal Reserve rate cut next month, September, as very likely. Pricing points to about an 85% likelihood. I'm not quite convinced it's a done deal just yet, but markets are very confident. On the central bank front, the RBA was in focus, the Reserve Bank of Australia, and it did cut interest rates again as expected. Remember, the RBA surprised everyone back in July by holding interest rates and not cutting them, but we did get that cut last week. That was a 0.25% reduction, and that took the cash rate to 3.6%. It was a unanimous decision, and not surprising because we have seen inflation weaken across the Tasman. The headline CPI now sitting at 2.1%. That's the lowest in almost a year and a half. So we will see more cuts from the RBA, I suspect, but I think they will just take their time and act a little bit cautiously. They next meet in September. I wouldn't be surprised if they pause in September and then move again in November. So the path is still down, but they are going to act quite cautiously. Here in New Zealand, there wasn't a lot that came out last week. We had some migration figures that were a little softer than expected. We also had some housing market data that reflected a still sluggish property market. This came from the Real Estate Institute. It was for July. Good and bad, activity did continue to push higher, so you're seeing more sales take place, and the days to sell didn't get any worse. It was fairly stable, but prices are still slipping. So we saw prices nationally fall for the 7th month out of the past 8 months. So national sales volumes up, days to sell stable, but prices down for the 5th month in a row and down 7 out of the last 8 months. The National House Price Index is now 1.3% lower in 2025. So about the same as the New Zealand share market, to be honest. So whether you've been in property, whether you've been in shares, New Zealand assets just haven't been delivering. You've been much better off to be well spread and to have put some of your capital internationally. And I'm sure all of you listeners do that, because I'm sure, at least if you're with Craig's, your advisor will be very big on international diversification. So I'm sure that New Zealand weakness isn't something that is causing you great problems in terms of portfolio returns in 2025. Right, looking to the week ahead, and it is a very busy one. There is a lot going on. One key event internationally will be the Central Banking Symposium in Jackson Hole, Wyoming, in the United States. This is an annual event. All the central bankers go to it from all around the world, so I'm sure there'll be representatives from the Reserve Bank of New Zealand that will be there. It's hosted by the Kansas City Fed, and it goes from Thursday through to Saturday. So this year's theme is all about the labour market, demographics, productivity, and you'll get a lot of speeches. The one that everyone will be watching will be from Fed Chair Jerome Powell. He will speak on Friday. So it's a really interesting time because you've got expectations for Fed rate cuts having risen, but you've also got some softer economic data and you've got evidence of mounting inflation. So conflicting signals for the Fed, weaker jobs market and some other indicators that suggest that the economy is slowing, but then evidence of tariff-induced price pressures. So it'll be interesting to see what they say. It'll also be notable because Powell's term expires in May next year, so it might be one of the last major speaking engagements we see from Jerome Powell as Fed Chair this term. In terms of economic releases, the focus will be on the global flash PMIs for August. Those are out on Thursday. There'll be other stuff as well. We've got inflation in the UK and Japan and in Canada, and we've got lots of other releases too. But those flash PMIs will be what I will be watching in terms of economic releases. I think we get the first one at 11 o'clock on Thursday morning out of Australia. Japan usually follows at 12:30, and then you usually get the same releases from the UK, Europe and the US that evening. Last month's PMIs were strong. Those were for July. These will be for August, so really hot off the press, really timely. All the major regions last month were above the break-even level, so that's good. The US PMI rose to 55.1. That's the highest we've seen all year. The Australian composite PMI hit a 3-year high, and corresponding measures from Europe and Japan hit the highest we've seen in sort of 4, 5, 6 months. The UK and emerging markets a little bit softer, but they were still above break-even. So pretty good news through July. We'll see if that's continued into August. Here in New Zealand, there are a couple of key things to watch. Wednesday will be a big day. In the morning, we'll get the results of the latest global dairy trade auction. They'll be out early in the morning. The agricultural sector obviously in pretty good spirits at the moment, and they will be hoping for the 3rd consecutive increase in the headline GDT index. The last 2 auctions have been up, so we'll see if we can make it 3 in a row. Most economists are still hopeful that we'll see see that $10 payout that we saw last year repeated. I actually see one of the banks, I think it was BNZ, have bumped their expectation up to $10.25. So the agricultural sector is still in good shape, even though you've got a stronger currency that has been weighing on returns over the course of this year. Year to date, the Kiwi dollar's up against the US dollar, but prices internationally have been up and demand isn't looking too bad. So dairy prices will be in focus early Wednesday morning. Wednesday afternoon, we will get the main event, and this will be the Reserve Bank's official cash rate decision, the OCR decision, and it will also be a monetary policy statement, an MPS. These are all released at 2 o'clock on Wednesday, and then at 3 o'clock there will be a press conference where you'll find more information. So just to recap where we're at, the Reserve Bank has cut the OCR 6 times this cycle. It started in August last year after the OCR spent about a year at a 15-year high of 5.5%. So we've seen 6 cuts, and that has taken it down to 3.25%. The Reserve Bank did pause at its last meeting in July, and that was the first time in a year that it had paused. However, we do expect it to resume its easing cycle this week, so a cut is highly likely. Everyone thinks so, I think so, everyone else out there agrees. Market pricing points to about a 90% chance of a cut of 0.25%. So that would take the OCR to 3%. But the big question is what happens after that. Financial markets see one further cut after that, which would take the OCR to 2.75%. And we will all be watching the economic and financial projections that will be in the MPS to see if the Reserve Bank is on a similar page. So cut expected this week, but it's all about what happens after that. Do they see more cuts ahead, and how many do they see? You know, some of the banks think the OCR will go down to 2.5%. That's entirely possible if the economy remains weak. It's also possible that if we see a stronger recovery, that they just do this week's cut and leave it there. I don't think they will. I think there's at least one more to come after this week. So I think 2.75 is much more likely than them stopping at 3%. But we'll wait and see. Wednesday afternoon, that will be very much the local highlight. It won't be the only thing to watch though, because the reporting season really heats up this week across Australia and New Zealand. We've had lots of international companies reporting over the last 3 or 4 weeks, but the focus will really shift to New Zealand and Australia this week. There's loads of companies reporting. In New Zealand, we'll hear from A2 Milk, Contact Energy, Freightways, Spark, Auckland Airport, plenty of others along the way too, as well as 2 of the market heavyweights holding annual meetings. Infratil and Fisher & Paykel Healthcare holding annual meetings, and that means we should get trading updates from those 2 businesses. Across the Tasman, there's just as much going on. BHP Group, Lendlease, CSL, Brambles, Goodman Group, just some of the companies that are reporting. While things are slowing down globally, there's still a few more to come, and the retail sector and the US consumer will be in focus this week. We had those retail sales last week. They were better than expected, but we also had consumer sentiment slip a little bit. That was a bit disappointing. This week, we will get corporate earnings releases from Home Depot, Lowe's, Target and Walmart. So the reporting season is certainly not over in the United States because we haven't heard from some of those key consumer-facing stocks, in particular Home Depot, Target and Walmart. So that will be interesting as well. Trump and Putin, obviously we had that summit as well. The news has just been drifting out today. It doesn't look like they really got anywhere. The headlines are all very friendly and positive, but not a lot of substance underneath. So I don't think that's any great surprise. I don't think you'll see a huge market reaction to that on Monday. I'm not sure any of us were really expecting anything concrete to come out of that. But look, I guess it's progress that they've actually sat down together in person and started talking. So hopefully those communication channels are open now, and maybe it is a first step towards the war in Ukraine easing and hopefully ending in a sustainable manner. All right, thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.